Separating myths from truth. This is a foundational presentation that just kind of explains how the system works. And normally I launch right into that, but one of the things I wanted to emphasize today is why is it important? I know this presentation is a little bit more graphs and charts, and so the nerds in the room will appreciate that. The free spirits will get their eyes gloss over, and I lose them pretty quick. But I would like to try to grab everybody by why this is important. I think if it's important enough, then paying attention becomes really important as well. And what makes this important is really the hopes and dreams that are attached to the monies that you're saving. And I think what I know is that if you recognize that the money that you're saving is attached to real opportunities that you have in the future, then you take seriously how those monies are invested and hold accountable those that are responsible for growing that. The hopes and dreams that we have, I think back to the hopes and dreams that my parents and my grandparents had. I have a picture here of a barn. This is a picture of a barn that was taken in 2013. The barn is in the Netherlands. It was a barn that my grandfather hid out in during the Nazi occupation. And what would happen is the Nazis would sweep through the towns and pick up any able-bodied men to work forced labor in the munitions factories that they needed help with. And so there were informants that would inform when they could, that would inform ahead of time when these sweeps would happen, and then the men that could get away would hide out. My grandfather hid out in that barn for 3 to 5 weeks at a time, a few different times during the war, and then my mom, who was the oldest one in the family, would get on her bike and she would ride out there with some food, and she'd sit and visit with him once in a while to kind of pass the time. He sat in that barn with a Bible and a couple books, and he had lots of time to think. And he never told me what he thought about, but I have no doubt that he dreamed a lot about coming to America, because as soon as the war was over, they bought passage for the whole family to go to America. And it wasn't a small task to immigrate to the United States at the time. Europe was a mess. It was a bombed out shell. Europe wasn't allowing, Netherlands specifically wasn't allowing any money, any cash to leave the country, because they needed the cash. And so when they moved to the United States, they converted all their cash to hard goods. So they bought furniture and things that they might need when they came to the United States, never having been there before. Most of them none of them speaking English. I don't know that any of my mom's siblings or parents spoke English when they came over. They were sponsored and came to Grand Rapids, Michigan. It's kind of funny, a mile from that barn, my dad lived with his family. My mom and dad never met while they were in the Netherlands, but when they came to the United States, they did meet and got married. But the dreams that he had, he was in his 40s, mid to late 40s at the time that they immigrated. The dreams that he had were less about himself and more about his kids and the future of his family. And those are the things that I think are worth thinking about as we think about what the importance is of our dreams and goals. The other reason I bring it up is that there's a lot of people that will tell you the American dream is dead, that you can't have the things that your parents have, that hard work and determination don't produce results, that the system is rigged, and if you work hard and you save money, that'll be taken away from you. And it's not true. It's not true for you and I. It's not true for our kids. And what we need to be doing is teaching them and telling them. And some of the things that we're going to talk about today are examples of how being disciplined and saving and investing in a way that's consistent with how markets work can make the American dream real for you. This is a Fox News poll about what people's ideas were for an American dream. Retiring comfortably is one that comes to mind pretty quickly. Having a successful career, owning a home. I had somebody, in fact, I think there's cards in your packets. If you want to open that first, there should be a card that says, what's your American dream? It's proven that when you write things down, especially goals, when you write goals down, they have the tendency to come true. And I wrote a goal down probably 22 or 23 years ago. I wanted to own 40 acres and a big red barn, and I wish I had the paper I wrote that on. I can remember the seminar I was at when I wrote it down, and the reality is we did buy a barn, house and a barn. I bought the barn, my wife bought the house, and it was It was burned out at the time. The house was built in 1890, but it's a beautiful home. The whole center had burned out. We bought it as a shell, but it happens to be on 40 acres, and we live out there with our family. And it's a dream that we had, and it was a dream that we were able to realize, and we're grateful for that. I'm not saying that every dream you have comes true, but I will say that if you take some time to write some of those things down, and then share them with others, if you'd like to leave the card behind and share it with me, I'd be honored. But if you take it home and share it with people you care about, these are the people that I care about. Some of them are here right now, and the hopes and dreams that I have extend beyond me to my family as well. Yeah, you can count them. There's 13 people there, and so 40 acres is hardly enough to contain them all. But but the question really is what's your American dream? And the importance of what we're doing here really feeds into the resources that resource your hopes and dreams, are the resources that we're talking about. So this is not a small conversation we're having or an unimportant conversation. So with that, we're going to move forward with the presentation. We're going to be covering three things in this presentation. The first one is dispelling some of the myths that surround investing. And then we're going to tell the academic story of investing and then give you an opportunity to act on that for yourself. One of the things I want to do is clarify a few things. I do not assume that everybody in the room understands some of the terminology that we're talking about. So there's a couple basic terms that I've taken a habit of defining for you. One is the market. The market is not the farmer's market. We're not talking about fruits and vegetables here today. The market is all of the publicly traded stocks available for sale in the world. So the global market is the world of available companies that you can buy publicly that are for sale. So the U.S. market would be all the U.S. companies. International market would be all the companies that aren't U.S. And so that's what the market is. And if I talk about the market, you have at least a sense for what that is. The next one is maybe more familiar, the S&P 500. Anybody know what the S&P 500 is? S&P is Standard & Poor's. What does 500 stand for? 500 largest U.S. companies. All right. The significance of that index is that nobody picks them. They exist just because they're the 500. So nobody gets to say, hey, you guys are going to be the 500 largest companies. They are because they are the biggest. And that's so it's an unmanaged index. And then that last word, index, just means that it's a list of companies. It's an index. It creates a model that can be copied. So nobody owns the S&P 500 index, but you may own a mutual fund that mirrors the S&P 500 index. So an S&P 500 mutual fund would be one that mirrors the S&P 500 index. But a lot of the charts and graphs we'll be comparing results to the S&P 500. That's just the value of the 500 largest companies, and it does tend to be representative of how the larger market is as a whole. What is a mutual fund? Some of these concepts seem pretty basic, but if you've never thought about it before, and somebody asks you what's a mutual fund, you're like, boy, I'm not really sure. Mutual fund is just a group of people that mutually pool their money, and they mutually pool their money into a fund, and then they collectively hire a money manager to manage that fund according to whatever standards or guidelines that they lay out. And so that's what a mutual fund is. It's not more complicated than that. And it's a terrific way to diversify into a broad pool of stocks, even if you only have a little bit of money. And that leads me to my last one. We had some feedback on some of the seminars a couple years ago that said, Steve doesn't like mutual funds, does he? Steve loves mutual funds. Mutual funds are great. The concept of diversifying money in a mutual fund is terrific. What Steve doesn't like is the financial industry has hijacked mutual funds. And what used to be a pool of mutual owners that hired a money manager has more recently become a money manager that you can buy into the mutual fund, and if you don't like what he's doing, then just get out. It's as if it's his money, not yours, and I think the financial industry has lost sight of that. And so when I'm ranting and railing on the financial industry, it's not mutual funds. It's really mutual fund managers and the way that the financial industry treats clients. So this is what we're going to be covering. And now you know a little bit some of the terminology that we're going to be discussing. The first thing that we're going to discuss is myths. So there's 4 different myths we're going to cover and describing what is a myth. A story made up to explain a phenomenon beyond the science of the day. So if you think about some myths that used to exist years ago, would be a myth that the Earth is flat. There were 4 corners to the Earth. Everybody knew that. The Earth was flat, and so if you went sailing off into the ocean, it was possible that you'd get to the edge and then fall right off. Magellan sailed around the world and proved that the world is indeed round, and now it's widely accepted, although I understand there is a website where you can join the flat Earth people. So apparently there's some people that are still contesting that even to this day. Another myth was that the sun revolved around the Earth. It came up in the east, it set in the west, and the sun went around the Earth. And Galileo proved that wrong. That no, the Earth and the whole solar system revolves around the sun. Got a lot of pushback for that, but eventually science proved that that was correct. Well, what we're talking about here today when it comes to investing is indeed the science and the math surrounding investing, and a number of myths that exist in the financial industry, and they still exist today. We've been teaching this stuff for 20 years, and there's still people that embrace this. Stock selection, what's the hot stock? What's going up, what's going down? You hear it on the top and bottom of the news. Track record investing. The people on the front of Fortune magazine or Time magazine that have been beating the market, or that navigated around the latest challenge. In the financial industry, market timing, getting into the market at the right time, getting out at the right time. These are things that news stations 24 hours a day, 7 days a week are pumping out all this information for you to listen to and respond to, get excited about or get scared about. And the last thing is the cost of investing. And so we're going to cover all of those today. And the first one we're going to choose is choosing stocks based on a belief that they'll do well in the future. All right, so it seems like that's what's supposed to be financial planners. And about 10, 12 years ago when we were introduced to free market investing for the first time, that's what I assumed financial planners did. I thought financial planners were supposed to get me in and out of the market at the right time, pick winners and not losers. The myth is that investment advisors can consistently and predictably add value through individual stock selection. So you own a mutual fund. There's a mutual fund manager. You're not picking stocks, but they're picking, which stocks are going to be in the mutual fund, which ones are going to sell, which ones are going to buy. They're making those decisions for you all the time. Now, one of the things that I think you know, but I'm going to remind you, is that the financial industry can make it look like they're doing something that they're not. And there's a lot of different ways that they do that. One of them that we talk about sometimes is the law of large numbers. There's just hundreds of thousands of people to try, so that the fact that 10 or 12 of them beat the market on any given year is not unreasonable, considering there's so many people trying. But another one that we talk about here is survivorship bias. Survivorship bias is something that the industry still does. It should be shocking and disappointing, but I'll explain to you what it is first, and then why it misleads people in thinking that the financial industry is providing a value that they're not doing. Survivorship bias, what this is there's actually 3 separate panels here. You can't see the shading's a little bit light, but there's one here, and one here. There's 3 panels. And it just shows year by year, 1923 all the way down to 2016. It just shows every year how many mutual funds were opened, how many mutual funds are killed off, and how many total mutual funds exist as of today. The first panel, interestingly, not a single mutual fund was closed. The first one opened in 1923, and then it grew from there. Started seeing some mutual funds killed off here, and then in the last 30 years, we're seeing thousands of mutual funds created every year and thousands of them being killed off. Now, if you had to think creatively for a minute about why might somebody kill off a mutual fund, what would be a reason for closing down a mutual fund? I mean, could it be because it's making so much money for clients and they're so happy with it, they're feeling guilty that maybe somebody else and they should close it for that? Could that be a reason why? No, what would be a more obvious reason why you'd close down a mutual fund? What's that? Insolvent. It performs so badly that so we're gonna look at that in a minute. Right now in 2016, 32,000 mutual funds at the end of last year were open. 32,000, that's a lot. 61,000 mutual funds have been opened since 1923. And almost 50%, about 47, 48% of mutual funds don't make it. So when you're looking at mutual funds that you can invest in, almost half of them won't be around by the time you retire. 28,000 mutual funds that killed off. We have an average of the top 200 mutual funds. I used to have a list of the top 200. The worst one was 99.5% negative return. It's kind of fun to look at how bad could a mutual fund really be. That would be insolvent, I think, John. The average for the 200 worst mutual fund was a negative 81% return. So if you had $100,000 at the beginning of the mutual fund when it opened, and you rode it all the way out to the end, you would have had less than $19,000 at the end when they gave you your money back and said, sorry, we tried, but it didn't work out so well. And they don't do that, actually. Most of the time, they just fold the mutual fund into another fund. Now, my point in showing you survivorship bias is not that 50% of mutual funds don't make it. That's not the point. And it's not even that the worst mutual funds have a negative 81% return. That's not the atrocity here. The atrocity is, what do they do with the return data for the mutual funds that fail? So these 200 mutual funds failed. Do they share with you what that return data was when they show you their history of performance over the last 20, 30, 40 years? No, they erase it. When a mutual fund does too badly, they erase it. They eliminate the mutual fund from, so you have 10 mutual funds and you're trying to choose from. 5 of them are going to do poorly, and 5 of them might survive. And what they do is, the funds that do poorly, they just erase that. Now the next person looks and says, how have you done? Oh, look at these 5 mutual funds. They've done great. But the people that invested in the 5 that failed lost money. Now, wouldn't you want to know that if you're trying to figure out whether or not a mutual fund company like Fidelity or Oppenheimer or American Funds is a credible source of information for your investments? I think you would. And so what we've done is we've gone back through, there's a research done through University of Chicago that goes back through and pulls out all the data for the mutual funds that didn't make it, as well as the ones that did, and shows the market performance for the average mutual funds over the last since 1972, so that's over 40 years, 45 years. It's even more than that. It's 55 years. The mutual funds, if you had $100,000 invested in 1972, the average mutual fund would have returned you $3.57 million. Now, some of you might not complain about having $3.57 million today, but the reality is that if you had just invested it in the S&P 500, you would have had nearly $7 million. If you had invested in a broader market, a little bit more than that yet. My point is that the value added by active management actually gives you a lower return, not a better return, and that's true here as well. The second slide here, it's a little bit different. It averages all mutual funds, including bond mutual funds. Bonds are more conservative. They earn less, and because they earn less, you're going to get a lower return across the board. But these 4 funds are free market funds. This one's very conservative, and this is more aggressive. The point being there is that there is no value added by active management in stock selection, and that's been proven in many different ways, many different scenarios. I don't think it's even contested much. Although one of the arguments I've just been hearing this year, which baffles me, is people say, well, we know that markets are efficient long term, but in the short term, we think that we can win and lose. And if you just thought about that, there is no long term unless a long term is a bunch of short term. So a long term, it's not long term if every single day it's not true. It's not true long term. It has to be something that's true every day if it's going to be true long term. And so some of the things that people use to try to make stock picking irrelevant today is humorous. The use of performance history. So the next myth is track record investing, the use of performance history to determine the best investments for the future. Finding funds that did well in the past is a reliable method for indicating which funds will do well in the future. And so when we're looking at track records, if you have to think about a track record, and this is pretty common. I think most people, when you're looking at your 401k and saying, hey, where can I invest my 401k? You're looking at the data that they put in the 401k brochure, and it says, hey, this is the performance over the last 5 years, 10 years, 20 years, or since inception. And the assumption is that if a money manager has been able to do it for 10 years, beat the market, boy, he must have something going for him, and maybe the next 10 years he can do it again, right? And so that's really what track record investing is. And when you're thinking about track records, what would be better, a long track record or a short one? What would be more valuable in your estimation? A long one, yeah, a long track record. And so what we're going to look at here is a 10-year track record. The top 30 U.S. equity funds from 1997 to 2006. So this is the top 30 mutual funds, the ones that performed the best for that 10-year period from 1997 to 2006. And you're looking at those top 30, they averaged 17% when the rest of the market, the average of all mutual funds and then the two indexes, the S&P 500 and the broad index of all U.S. companies did less than half of that, right? So you're looking at that thinking, boy, these guys know something that nobody else knows, and this is where I want to be. I want to put my money in one of these. And frankly, if you were looking at, talking to a financial planner that was that believed in active management, it's not unlikely that he would give you a list of mutual funds that one or two of those top 30 would be on that because they're getting all the attention right now. Now, one of the things that you need to realize is that you're talking to your financial planner on January 1 of 2007, right? Did you get any of these returns? No, you haven't got any of these yet, right? And which one are you expecting? You're expecting to get something better than everybody else. You're selecting, you're trying to get something better. And so the next 10 years is really what you're going to be experiencing. And so what does the next 10 years do? From 2007 to 2016, those top 30 mutual funds averaged 5%, when the S&P 500 and the CRSP did 1 or 2% better than that, right? So these didn't repeat again. Now you think about it, how many mutual funds are there? The slide that we looked at earlier said at the end of 2016, 32,000 mutual funds. Out of 32,000 mutual fund managers trying to beat the market, there's probably a statistical certainty that 30 of them will, right? But is it because they're so smart? Or could it just be luck if you're flipping coins, right? If I have 1,000 people flipping coins, it's a statistical certainty that somebody is going to flip 10 heads in a row. Is that fair? Somebody's going to do it. What the mutual fund industry wants you to do is pick those 10 people in advance. So they want you to say, hey, which one, before they do it, which one's going to do the 10 heads? And that's the impossibility. I'm not surprised that somebody can beat the market 10 years in a row. I just can't pick who that's going to be. And I just don't think, based on my belief about the markets, that it has anything to do with their genius. So that's a long track record. What I know is that most mutual fund investors are only in their mutual funds for about 4 to 5 years. So people buy and sell mutual funds quite often. And so why go bother with a 10-year track record if most people are only in a mutual fund for 5 years? So this is the 5 years from 2007 to 2011. If you know anything about the last financial crisis, that really puts you squarely in the middle of the financial crisis. It started in 2007, ended in 2009. And there were 30 mutual fund managers that navigated their way through that and provided their clients a 5% positive rate of return when everybody else was screaming and complaining about losses, right? You think those people were pretty popular? They were very popular, and people were crowing about how well they did when the rest of the market was doing zero or worse. The next 5 years, though, the rest of the market came back with a tear. And again, you were talking to the money manager on January 1 of 2012. You didn't get the 5% returns, right? You were looking to get above market returns again the next 5 years, and you underperformed the market pretty broadly. So a manager's ability to pick stocks in the past has little or no correlation with his ability to do so consistently in the future. Markets provide returns, not advisors. That's the key. So it's not the track record of the advisor that you need. There's reasons why those 30 mutual funds did well. It's typically because they were focused on an asset class that happened to be doing well during the market downturn. So the third myth is market timing. What is it? What's market timing? It's any attempt to alter or change a mix of assets based on a prediction or a forecast about the future. And the myth is that money managers are able to utilize market timing to effectively predict up and down markets. And this happens all the time. We are, the key word in there is predict. We are a society that's addicted to predictions, and now more than ever. And we live under the illusion that we're getting better and better at predicting things, and the reality is it's not true. Think about the things that we try to anticipate and predict. Sports. You could spend 3 weeks watching about all the lead up to a Super Bowl game and all the predictions that are being made. And do they mean really anything by the time the game is played and the score and everything's settled? They predicted every possible outcome, so the fact that somebody got it right just means that there weren't any outcomes that weren't predicted, so somebody was bound to get it right. The weather, are we better at predicting the weather now than we ever were before? I mean, what's it going to do tomorrow? Well, we know, because we know that there's rain in Wisconsin and it's coming over this way, and tomorrow it's going to be wet. I know that, right? That's not so much a prediction as it is we just have better maps than we did before. But can you tell me whether or not I should buy a new snowblower for this winter? Because I don't know if I'm going to get a lot of snow or a little bit of snow. Some years there is and some years there isn't. And Bill Steffens, God love him, doesn't get it right most years, right? My farmer plants corn, right? And if it's going to be a drought like 2012, he might as well just leave his tractor in the barn. It'd be really nice for him if you could just tell him whether or not it's going to be a complete washout and everything's going to flood, or if it's going to be a decent season, and he can decide what he's going to plant, corn or soybeans, based on the weather. But the reality is they can't predict next summer's weather any better than they can predict what's going to happen in the markets. 2016 was such a great example of this. But let me go on. I'm going to get off here. Dalbar Research. Dalbar is a really interesting study. We get their study every year. And Dalbar does research on something that people scratch their head about. They research on what the returns are for the investors inside the mutual funds, not just what the returns at the mutual fund state, which people scratch their head and say, wouldn't they be the same? If the mutual fund gets a 10% return, wouldn't the people inside the mutual fund get 10% return? That'd be logical, wouldn't it? But the reality is that the mutual fund posts a return based on what their average rates of return are. So we looked at those slides before. If a mutual fund posts for a 5-year period a 20% average rate of return for 5 years, and the next 5 years they post a 0% rate of return for the next 5 years. Now they've got a 10-year rate of return with it averages what? It averages 10%, right? 5 years at 20%, 5 years at 0, averages a 10% rate of return. When did most people get into the mutual fund, do you think? The second 5 years, right? What did most people inside the mutual fund get? Did they get 10%? Most of them got 0%, thinking that they were going to get 20, right? They didn't jump in until Morningstar rated them a 5-star, and then and their financial planner said, "Hey, look at 5-star rating. You should get into this one." And so they jumped in. Most people are jumping around from one mutual fund to another, and because of that, they're decimating their return. So Dalbar's research shows that at the end of 2016, over that 20-year period, the average equity investor averages about 4%. You might see this in your 401k. It's not that great. When the S&P 500 averaged 10%. And one of the reasons why is because the average investor is getting in and out and trying to time the market. Market timing is very, very hard. It's very stressful. And here's just an easy example for understanding this. This chart shows what a $10,000 investment would do over a 20-year period of time. During that 20-year period, there's 5,040 trading days in that 20-year period. 5,040 trading days. And if you just missed, so the average $10,000 invested would grow to almost $50,000, just under. If you missed the 10 best days out of 5,040 days by getting in and out of the market at the wrong time, the 10 best days, your investment would have been cut in half. The 10,000 would have grown to about 2,500 or 25,000. And if you missed the best 30 days, you would have little more than you started with. The $10,000 would be worth at the end of 20 years about $10,000. Now you're talking about 5,040 trading days, and you just need to be in the market for the best 30 days in order to get those returns. And it's very hard to be in the best days. The other reason why it's hard if you think about it, the very best days in the market, the very best months, the very best years in the market tend to follow the very worst years in the market. So when you have a really bad year, it's oftentimes the subsequent years immediately following that the market really has a tear. But most people got so burned by the market going down that they pulled their money out, and they want to wait until they're sure the market's back before they do something, and they miss those best days. It's not easy to time the market. Market timing is very difficult. And the industry's doing it on steroids. There's two different types of market timing. The most obvious one is getting all in. I'm all in the market, and I get all out when I get scared, and then when I get optimistic, I get all back in again, right? But that's not how that's not how most financial planners do market timing. They do tactical, what they call tactical asset allocation. They don't want you to take the money out of the market. They want you to leave it in. But boy, I'm a little bit scared about internationals. You know, Donald Trump said it's going to be really great and we're going to be huge and the wall and all that stuff. I think we should get out of international and get into more U.S. Or I think, I think gold has played itself out and we want to get into more real estate. And so what they're doing is they're meeting with you regularly and they're selling some of this and buying some of that, and they're just moving money around. They're tactically allocating assets and making changes for you. And that is actually worse, because what they're oftentimes doing is chasing returns. And so one starts to go down and say, well, that's not working. Let's find something else. And that one goes down. And I've seen people tactically allocate assets and decimate a portfolio. And it's kind of sad. So beware of market timing. Charlie Ellis, in his book, Investment Policy, which is used in textbooks in a lot of different schools, including University of Chicago. The evidence of investment managers' success with market timing is impressive and overwhelmingly negative. So a summary there would be impressively negative is what the summary is there for market timing. And then the fourth thing, as it relates to investing, is the costs of investing, fees incurred by investors to buy, sell, and own stocks or mutual funds. The myth is that what you don't see won't hurt you. I listen to talk radio. I'm not sure if anybody else does. I prefer talk radio for most music stations. Adam Bold is used to be on for the Money Store or Mutual Fund Store, I think it was. And so I'm in my car on Saturday mornings listening to it and yelling at the radio because he's lying to people. I'm saying, you're lying, stop lying. And one of the things that he said that just really annoyed me was that it doesn't really matter how much the mutual fund manager charges, it's really how much he makes you. So if he charges a 3% fee, but he's making you 6%, then who cares? It doesn't matter what he's charging. And the lie about that, there's a couple lies in there. One is the mutual fund manager is charging you 3 or 4 or 5%, and they do when they're hot and they're full of themselves and people are chasing after them. Their fees go up. When they're charging fees like that, it's because they think that the returns come from them. They think it's their genius that's doing it, and that it's not yours. The reality is, what we know, it's the markets that provide returns, not money managers. So money managers that charge too much are charging it because they think a lot of themselves, and that's a lie. The second thing that you need to know about fees is that the fees don't go down when the returns go away. So if they're making you 6% returns, the next year they're making you negative 16, guess what? The 3% fee stays. It doesn't go away when the fees go down. So the next time somebody tells you that, you can quietly know that there's a lie. You don't have to yell at them. A couple of costs, bid and ask spreads and mutual fund expenses. Inside of mutual funds, there's expenses. You can, it's usually on page 28 or 56 or 37 of the prospectus, fine print. You can find it somewhere in there. The mutual fund expenses you can. The bid-ask spreads you can't. What a bid-ask spread is, it's the difference between the buy price and the sell price of a stock. I didn't even know this existed until I took a little bit of money with Susan's permission. I took a little bit of money and was playing the market. This was back in 2003 and 4. And so I was looking at the price of stocks. I was looking at Cisco, and there were two different prices. There was a price of the stock. If I was buying it, it could be $50 a share, but if I was selling it, it was $49 a share. There were two different prices. The difference between the two, the spread, is what the market maker makes. So when you watch CNN in the morning, when they have the they used to have all those guys with their fingers and they had paper flying all over the place. Now it's all computerized and there's no drama left. But the opening bell, they have these towers on the floors, and the market makers create a market for these stocks, and the market makers make that spread, and it doesn't matter who you are. It doesn't matter if you're an individual investor buying 1 or 2 shares, or if you're an institutional investor buying millions of shares, everybody pays the spread. And that spread can get very expensive. It's less expensive on the large stocks because those large stocks turn over very quickly. 4 basis points means 0.04% of every dollar goes to the market maker. But there's millions of shares of stocks trading every day. But the small ones, 13 basis points or 32 basis points, these are stocks that aren't traded very often. There's not a really big market for them. And so the cost of trading those are very high. And so a lot of active traders avoid these asset classes. We're going to talk a little bit later about why these are so valuable. But they're only valuable if you buy and hold them, not if you're trying to churn them and turn them over frequently. The cost of turnover doesn't show up anywhere. It's been estimated a number of different times in a number of different ways. The bid-ask spread is a percentage of the estimate actual trading cost. The estimate is over 8 times greater for the smallest than the largest. And then Charlie Ellis again. The key question under the new rules of the game is this: how much better must an active manager be to at least recover the cost of active management? The answer is daunting. The studies that we've shown anywhere from 1% to 4%. So somebody that's trying to beat the market has to beat the market by 1 to 4% in order to overcome the drag of that bid-ask spread on the turnover. So if you see a mutual fund that has 180% turnover, and they list it sometimes on their prospectuses, 180% means that they turned over all their stocks almost twice in that year. So they owned Microsoft, they sold Microsoft, and they bought it again, and then they sold it again, and then they bought it again. Well, every time they did that, they paid that bid-ask spread coming out and coming back in again, and that's your money. It's costing you. They're gambling with your money, not their own. So far, we talked about the 4 myths: stock selection, track record investing, market timing, and the cost of investing. We talked a little bit about why it's important to know what these are and why these are important to you. And I used to say, okay, that's all, let's eat dinner and go home, and leave you there. The reality is there is an answer to the myths of investing, and the answer is an academic approach to investments and financing that addresses those and still allows you to achieve the market returns that you're looking for and that you expect, and I would say deserve. If you're putting the money in the market and you're taking the risk, you deserve to get the returns that the market provides and not be limited to the mismanagement that active management brings. So we're gonna take a look at what that academic approach is. We call it the story of investing, and the term that we use for it is free market portfolio theory. So free markets, you hear me talk about that a lot. Free markets are what's the foundation of what we're doing here, and then the theory behind this. The theory is based on an investment approach that has strong academic underpinnings. It's a disciplined approach that seeks to capture market returns. What our opinion is that you don't need to beat the market. It's our opinion that the market is very generous, and that if you get market returns, you should be thrilled with that. And people that are trying to beat the market are playing a loser's game. So a disciplined approach, market returns, there's 3 components to this theory, and we're going to go through each one. The first one is just a belief. It's a confidence that the free markets work. The second is modern portfolio theory. It's probably the most groundbreaking piece of investing research that's been done since the 1950s. And then the last one is the 3-factor model. And we're going to touch on those. The leading academics here, Harry Markowitz and Merton Miller won the Nobel Prize in 1990 for some theories in the 1950s. I think both of those guys are still alive, and they did most of their research in University of Chicago. I've never met them, but I did meet Rex Sinquefield. I've not met Robert Iverson, but I've met Eugene Fama a couple times, and Ken French I met in Austin once. And these guys are like rock stars in the free market field, and like I'm a groupie, and then I go run and see the conferences and seminars they go to. But they're very humble guys. If I saw an interview that Mark Manson did with Eugene Fama probably a year or two ago, just a very, very humble guy, and just really, really appreciated his opinion. Mark was challenging him on some new ideas that were coming out and that were challenging whether or not efficient market theory. He won the Nobel Prize, by the way, in 2013. It's fun to meet a guy and then see him win the Nobel Prize. It just makes you feel like you're smarter than you were before. But Mark was asking him about, hey, what about these new ideas that people say? And he says, bring it on. It's he said the research that he did over the last 30 or 40 years, he said it gets vetted every year. And which means it gets challenged. They keep challenging and they keep challenging. He said it makes it better and better and better. And he says it's held up and it continues to hold up. It's very reliable. And he said, and he didn't say it in an arrogant way. He just said, that's interesting. But when I look at the data, they were talking about bubbles, real estate bubbles and bubbles in the markets. And he says, when I look at the data, he said, I just don't see it there. So when you define a bubble, you put parameters on it. And then you take that parameters and you bring it to the market and you see every other place where those parameters exist. And then you look to see if those pop and they don't always. And you don't know which ones are and which ones aren't. And so, bubbles in the market, like a real estate bubble or you name it, those are things that are really about market timing and predictions. He said the market doesn't really have bubbles in the market. The market's efficient. And so just listening to him talk, he wasn't proud or arrogant, but just very credible. And this is his definition of what free market is. A free market, a free market at any point in time, the actual price of a security will be a good estimate of its intrinsic value. So if you believe that statement's true, or you don't believe that statement's true, because you don't have to, if you believe that statement's false, so you believe that free markets fail, so free markets don't work to price goods and services efficiently. Free markets fail, that means they fail to price goods and services efficiently. It's possible for some individuals to identify in advance which prices are accurate or inaccurate. Underpriced or overvalued markets can be forecasted and predicted. And managers that seek to increase returns to avoid losses by taking advantage of market mispricings, people who believe that markets that the free market fails should work with traditional investment advisors that believe that as well. The alternative is that believing that free markets work. Free markets are best determined of prices based on supply and demand. All information is factored into the current price. So, for example, if you think that, gas prices have been down for so long and they're bound to go up, and I think that gas prices are due to just skyrocket, and then energy companies are going to do really, really well, and I'm going to buy stock in energy companies. Energy companies are undervalued, in your opinion. What this states is that the market knows everything you know and far more than you know, and the price of the energy companies today are what they're worth today. The randomness of the market makes it impossible for any individual or entity to consistently predict market movements to capture additional returns unrelated to risk. And so if you believe that free markets work, you should work with an advisor that believes the same thing you do. And this is probably the slide that if you forgot everything else tonight and just remembered this, in fact, if you just remembered that there is a debate between whether or not free markets work and free markets fail, you don't even have to decide which side you're on right now. But if you just knew that there's a debate between the two, and you should probably figure out which side you're on, that would be helpful. I used to think that results came from actions, right? So if you wanted good results, you should take good actions. And if you want bad results, you should take bad actions, right? Sounds logical? But what I learned years ago was that our results really come from our beliefs. Because our beliefs inform our actions. And our actions produce the results that we get. So if you believe the right things, you're going to take the right action and you're going to get the right results. When the market was tanking in 2008, right? It was the same market for everybody. Some people panicked and got out. Some people didn't and stayed in. Why? Because some people believed differently than others. And it was their beliefs that dictated their actions. So this is an important decision. Do you believe free markets work? Focus on capturing market returns, not beating the market. Eliminate traditional investment strategies. Utilize asset classes or structured funds. We'll talk about that later. Diversify prudently. Identify your risk tolerance. This is not a one-size-fits-all. Different people have different levels of risk. and the free markets can accommodate that. And then work with a financial coach who shares your market belief. The alternative is believe that markets fail. They focus on active management, pursue traditional investment strategies, stay connected to multiple sources of financial information at all times, because you're believing that the information you have is creating the results that you want. And so you need to read as much market information as you can, or work with a financial professional who shares your market belief and does the work for you. So this is really the decision that you need to make. And what we're going to move forward on right now is the assumption and the belief that I hold that free markets work, and they work well to reward disciplined investors. So that's the first component, belief in the free markets work. The second is modern portfolio theory. Modern portfolio theory, these are the people that introduced it. Harry Markowitz is a mathematician, and for the first time in the 1950s, nobody had ever done it. They applied mathematics to stock market performance, and began to publish the results of his findings, and develop modern portfolio theory. If you Google Markowitz, you will get lots of websites that show this very graph. And the significance of what Harry Markowitz determined is that you can actually get higher returns with less risk by diversifying. And so here's an example of it. The S&P 500 averaged over this, from 73 to 2016, that 44-year period, averaged about 10% rate of return with a level of risk of 18. That's standard deviation. It just shows how volatile the S&P 500 is. And what Harry Markowitz proved is that you could actually get a better return with less risk by just diversifying better. And there's a couple things that needed to be true, that he proved to be true in order to accomplish that. One is that returns come from asset classes. Now, I'm just remembering that I gave you a workbook, and in the workbook there's pages, and some of you are following along and some of you aren't. What page are we on? Do you know? 14. So if you haven't been filling, there are blanks here, and you can fill those blanks in. And when you get home and you don't have the answers, please give William or myself a call, and we'll fill it in. There's some people that have a really hard time with with blanks in their workbooks when they go home, and they can't sleep at night. So I'm not one of those, but if you're that kind of person, then get some counseling and give me a call. That'd be great. Asset classes determine where returns come. They come from majority of the returns come from the asset class. And what that means, we talked about the S&P 500, right? 500 largest U.S. companies. That's an asset class. That's a group of stocks that we call an asset class. The S&P 500 it tends to be a cohesive group, so those stocks tend to go up and down together. And what Harry Markowitz showed mathematically is that if you owned Apple Corporation and Microsoft Corporation, both of them are U.S. large company stocks, 92% of your return and owning both those stocks are going to come because they're in the U.S. large asset class. So 92% just becomes from, if you own a U.S. large company and that asset class is doing well, then you're likely going to do well. And if it's doing badly, you're likely going to do badly. So 92%, only 5%, 4.6 actually, comes from which stock you own. So you might do a little better if Microsoft is doing better than Apple, but that's only 5% of the returns, and then other factors about 2%, and then timing the market, getting in and out at the right time is less than 2%. So that was the first thing, asset class. And then the second thing he did is he combined asset classes together. So he said, let's take U.S. large and let's take U.S. small. Now, both of them go up over time. So if you own them both, over time, they both give you a positive return. But the interesting thing is they don't give you a positive return at the same time. Some years one's down and the other one's up, and the other one's up and the other one's down. And when you own both of them together, what happens is you get the benefit of watching your returns take the middle road. Now there are no asset classes that are this oppositely correlated, but it shows for a good example. Your return is still positive, but you just don't take the highs and lows and everything. So it's a much smoother ride when you do that. And when you're diversifying properly, the biggest risk is volatility. It's not so much that you're going to lose money. It's just that the market might be down when you need to get money out, and that could be a risk for you. Here's an example of that. You could own just the S&P 500, 100% of your money. An average rate of return over this period of time was 10% with a 16% standard deviation of risk. If you diversified into international, your return could go down slightly, but the risk goes down as well. And then diversify further from international large to international small. Your returns jump to 10.8 on average, and the risk continues to go down. So what Harry Markowitz began to do is draw out how can we improve returns and lower risk by combining asset classes. And this is just a very small example of that, how we do that. So that was component number 2, is embracing Harry Markowitz's efficient markets and the free market portfolio theory. And then the last one is some research that Eugene Fama and Ken French did in the 1970s, and they did this piggybacking off of the research that Harry Markowitz did. And what they did is they looked at all the markets and all the asset classes, and they said some asset classes tend to outperform the market averages. And there's 3 factors. One is the size factor, and the other is the value factor. The first thing is that you need to be in the market to get market returns. And so anybody that tells you that they can get you market returns with T-bill risk is lying to you. They're lying. And so it doesn't work. The S&P 500, these are stocks, outperform U.S. Treasury bills, right? But you don't own U.S. Treasury bills for growth. You own it for safety. U.S. Treasury bills are very safe. And so if you want to get the returns the market offers, you need to be in the market, first of all. So the first thing is you need to own equities. The second thing is the size of the companies matter. What Eugene Fama and Ken French proved, and they proved this not just in the U.S. economy. So what's interesting is this same phenomenon appears in every single market that they tested. So in the European market, in the Brazilian market, in every single stock market they tested, they find the same thing to be true, is that small company stocks over time outperform large companies. And they show that here. The S&P 500 averaged 10, small companies 11.5, but small companies are much more volatile. So you get a better return, but you just take a whole lot more risk. Right? So it's a bumpy ride, and for most people, they don't have the stomach for it. They don't have the stomach for it. Also, we saw in those slides earlier is that the cost of owning small company stocks is much higher. And then the last one is value factor. A value company is a company that's distressed. So, Kmart used to be a distressed company. I don't know if they're even around anymore. Are they? The one here in Grand Rapids closed, but they were like a value company forever. They never seemed to get out of their value mode. But a company that maybe the CEO got in the press over some scandal. Uber guy is out. Very likely the stock takes a hit because of that, or maybe a product doesn't release well, or things like that. And the stock can become a value stock, meaning the stock is depressed because of that. Most times, those companies do recover. And so if you own value companies, when they're depressed, they come back. And what you see here is that they offer a 2% premium over the U.S. large, but that premium comes at a risk. There's a lot more volatility. It's just a bumpier ride, right? So what Eugene Fama and Ken French said, okay, we know now that this is true. Now if we own those stocks along with U.S. large, it can mute some of the impact of that higher volatility. And so what we're looking at here then is modern portfolio theory is these 3 components. Free markets work, you add more modern portfolio theory to it in the 3-factor model, and you get free market portfolio theory, and that's the foundation or the philosophy that if you're clients of mine, and about half the room are clients here, if you're clients, that's the philosophy and the theory that's informing how we invest in the money. And so the money that you have invested with us. So the average investor, what we looked at earlier with the Dalbar study, is the average investor gets less than 4% average rate of return when the S&P 500 does 10. And the reason why, do you remember why that is? They buy and sell a lot, so they're moving in and out of the mutual funds quite often, oftentimes chasing after returns. They're chasing after the market, actively picking stocks and market timing. So the average investor is hurt by those kind of things. So simply moving out of that and into a standard S&P 500 would move you from an average of 4% to something over 10% just by doing that. But by diversifying further, we can reduce risk dramatically. So here, what you see is that where we were just in the S&P 500, Now we're in a portfolio that has 40% bonds and 60% US large. And what happens to the returns? The returns go down, of course, because you're reducing the risk, but you're reducing risk dramatically. And so it's a good trade-off if you're trying to smooth out the ride for your investments. We diversify further into international. So here's international large and small. So we took half of this and split it between those two. Your returns jumped up another 0.5%, and the risk went up a little bit for that. And then we can diversify even further into US small value, and large value. So these are the value, and we took that out of the large as well. And the returns jumped up almost a full percent, and the risk went up a little bit because of the way it was diversified. So this is an example of what we're doing in creating diversification in your portfolio. So creating a free market portfolio, for those that, that own these already, these are the different mutual funds. If you count them up, the different asset classes that are represented here, there's 21 or 23, depending on which ones you combine. Some of the smaller ones we combine sometimes. And then this is an example of a mixture of assets that's in a 60-40 fund, 60% stocks, 40% bonds. And so it just shows how diversified you can be. There's 16,000 individual holdings in there, 46 different countries. Like I said, over 20 asset classes represented. Diversification provides protection against the extremes and the ups and downs. So keeping your American dream alive and well, the free markets work for you. If you've not been introduced to this before, it's worth investigating. It's important to be investigating, and I'm excited that you're here. And for those of you that are already invested and have seen this presentation before, it's good to be reminded. I know that every time you go, you pull something else out that you hadn't seen before. And I also know this, is that it builds a confidence and when the markets are doing strange things, you don't have to worry. You can have a peace of mind knowing that, hey, it's built well and it's going to survive the ups and downs. So free markets work. What I want to do here now is turn to the last page, or second to the last page of the 20 answered questions. What page number is that? Page 19. All right, we coach clients to these 20 questions. And so I'm going to have you go through these. If you've gone through them before, I'd love you to go through them again. Every time you go through them, my hope is that you'll answer more of them yes. And if you're frustrated that you're not answering enough of them yes, then schedule a time to meet and we'll go through some of these things and try to help you understand it. Again, I think peace of mind around investing doesn't come when the market's up. I've seen people that when the market's up 39% like it was in 2013, that they were more stressed than ever because they didn't know why the market went up. They didn't know when it would go down again, and they seemed to be more stressed as their assets went up than when they didn't have anything. And really, peace of mind comes from understanding how the markets work. That way, when it's up or when it's down, you don't have to stress about it because you understand that's normal for the markets, and it is. So we're going to go through these questions, and I'm going to read them off to you, and you're going to mark them yes or no. Do you have a booklet? This is my wife, Susan, and she doesn't have a booklet, and so she's going to run and get one. She's going to do the 20 must-answer questions, and then she and I are going to go through them together tonight. It's going to be great, honey. You're going to love this. Whew, it'll be fun. So anyway, the first one is the most important one and the one I like the best. It says, have you discovered your true purpose for money, that which is more important than money itself? If you take all the words out there except for purpose, really that question just says, what's your purpose? And if you know what your purpose is, then money should be resourcing that. If your purpose is money, I can't help you. I think you're going to be frustrated and sad the rest of your life. I hope that your purpose is meaningful and deep, and that the money that the wealth and the abundance that we have in this country is something that can be directed toward a purpose that you can get excited about. So if you've not ever written that down before, just write no and then make a mental note to figure out what that is, and it changes. So your purpose for money develops. The first time I answered that question was different than the 10th time and the 15th time. So it develops as you think about it more. Are you invested in the market? If you have any free market funds, or if you If you have a 401k that has equity mutual funds in it, then yes, you are invested in the market. So you can give yourself a yes for that. Do you know how markets work? If some of the things that you've heard here is the first time you've heard it and it makes sense to you and you think you know it, I'd still mark no. And if it's something that you've heard many times before and you're convinced, yes, this is how markets work, then give yourself a yes. Have you defined your investment philosophy? We talked about two philosophies here today. Have you defined for yourself where you stand and what your philosophy is? Have you identified your personal risk tolerance? Everybody's risk tolerance is different. And so what I talked about earlier is that the free market investing isn't a one-size-fits-all. It's specific to the level of risk that you can manage and handle. And no looking at your friend's answers. It's okay. That's right. Cover him up because he was speaking. Do you know how to measure diversification? Sorry. I told you not to pick on me, and now I'm picking on you. So, do you know how to measure diversification in your portfolio? We talked a little bit about that with, if you've never done that, there's actual mathematical calculations that calculate that for you, and you can have that for yourself. Do you consistently and predictably achieve market returns? You know something? When I meet with clients, most of them don't even know what the market returns are. And because they don't know what the market returns are, if their advisor got them a 12% return and they were happy with that, and the market did 18% that year, they still underperform the market. So if you don't know what the market actually has been returning, it's really hard for you to know whether you're getting market returns. So put a no there if that's true for you. Have you measured the total amount of commissions and costs in your portfolio? A lot of people don't know how much they're paying in their portfolio, and there's a variety of ways that the financial industry charges you. It should be very upfront and transparent, but it's not. And so if you're interested in that and you don't know, put no there, and we can help you with that. Do you know where you fall in the Markowitz efficient frontier? And that's that graph, and we can plot people's investments on that graph and show you where you're at. It's probably the most groundbreaking financial research done in the financial industry over the last 100 years, and it wouldn't be difficult to figure out where you fall on that if that was interest to you. When it comes to building your investment portfolio, do you know exactly what you're doing and why? And when I say exactly, it doesn't mean that you know how to do the formulas and the math, but you know conceptually. I understand why we're doing what we're doing and how we're doing it and why that's important. And so it's possible to answer that question even if you're not a PhD in math. Are you working with a financial planner or a coach? I used to say if you answer the first 10 correctly, then you're probably working with a financial coach, but I have a lot of clients here that don't answer the first 10 yes, and they're working with a financial coach. The difference really is a financial planning industry has typically been very hands-off. I'll give you the money, I'll tell you I want to retire in 15 years, and then you just get me there. And the financial industry said, hey, just don't ask any questions, we'll do it for you, and it'll be great. And then 10 years into it, you've got 5 years left to retirement, and it's not great, and you're not at all happy with where things are at, and then you pull your money out and you start all over again, and you really don't know why that person failed or what you're looking for again in the future. And so the financial planning, it doesn't foster any peace of mind. I think the coaching is really emphasizes on helping you understand why you're doing what you're doing. Do you have a customized lifelong game plan to guide all your financial decisions? I'm going to move through this so we can get to dinner here. Do you have an investment policy statement? Every individual account that we set up has their own individual policy statement, and they're different for each account based on what the account's for or what the purpose is for. And we could show that to you if you're looking for that in your paperwork. Have you devised a clear-cut method for measuring success and failure in your portfolio? You can't hold me accountable if you don't know what success looks like or failure looks like, and so we would need to talk about that if you're not certain what that is. Do you fully understand the implications and applications of diversification? So a lot of people think I own a lot of stuff. I have 10 different mutual funds. When I look at the mutual funds, oftentimes 7 of them are U.S. large company mutual funds, and they're all going up and down at the same time. So they're really not diversified, and I think understanding the diversification in your portfolio is helpful. Do you have a system for measuring volatility? We use standard deviation of risk. We saw some of those numbers up there. We can calculate that standard deviation for any portfolio that's available in the market today. Are you aware of the costs associated with purchasing commission-based products? And there's direct costs and hidden costs to that. Number 18, do you know the 3 warning signs that you may be speculating with your money versus prudently investing? Boy, everybody could answer yes to that if they remembered stock picking, track record investing, market timing, and then you could say, oh yeah, and you could put yes on that. Those are 3 warning signs that you might be speculating and gambling. Can you identify the cultural messages and personal mindsets about money that destroy your investing peace of mind? When I think about what my job is not to get you 20% returns. I don't deliver returns to my clients, the markets deliver returns. My number one job is to give you peace of mind about what you're doing. Create reasonable expectations for what the market can deliver based on the level of risk you're taking, based on the money that you're putting in, based on the time horizon that you have, and then create peace of mind around those decisions. And so if there are lots of things that destroy that peace of mind, and we focus on those, and we'd love to help you with that if you have questions. And then lastly, are you ready to shift your personal experience of money and investing from a scarcity mode to an abundance mode, where you can live your life rather than obsess about your assets? And so look at that question. If you mark a yes on there, don't hesitate to tag William sometime in the break, and he can schedule some time for us to discuss this for yourself as well. But what we're excited about and what we're confident of here is that the American dream is alive and well here in the United States. That you can own it. It doesn't mean that it's easy. It was not easy for my grandparents coming over from the Netherlands. My parents made some really tough calls trying to provide for their family. It's hard work, and the outcomes aren't guaranteed, but the rewards are terrific. And the risk and the rewards for the hard work that we put in is something that we grow from, and that we can. I think everybody testifies and says, "Hey, it was really hard, but looking back, I'm so glad I went through it." And that's true for a lot of different folks. So if you're interested in changing that for yourself, then tag William. There's a card in your packet that you can fill out. We'll go back to that later, but you can fill that out and give that to him as well. And if you don't have a date right now that we can meet, then he can schedule one for us later. So that is the separating myths from truth. And I'm for those of you who've heard it before, I'm glad you're hearing it again. And for those that have heard it for the first time, think about some of those key concepts that we're covering here.